The economy can look healthy on paper, while your personal finances feel completely broken. You have a job, you get paid, you walk into a grocery store, and somehow, the same paycheck doesn't buy what it used to. Then you look at housing. Home prices aren't falling everywhere. Mortgage payments are still expensive. And for millions of younger Americans, buying a home has gone from a normal milestone to something that feels almost impossible. At the same time, you keep hearing another warning. The US dollar is losing its power. De-dollarization. BRICS. Alternative currencies. A changing global financial system. But how much of this is actually happening? And more importantly, what does any of it mean for your money? Because 2026 may not feel like a traditional recession. It may feel something much quieter. A slow squeeze on purchasing power. And today, we're going to break down 4 major shifts changing the financial lives of ordinary Americans. Part 1. Let's start with the phrase everyone needs to understand. A silent recession. This isn't necessarily an official economic definition. It's a way of describing something millions of households can experience even when the economy isn't technically in a recession. Here's the problem. Economic statistics measure the economy as a whole. Your bank account measures your life. And those two things can tell very different stories. Imagine Alex. Alex earns $70,000 a year. 5 years ago, that salary might have felt comfortable in his city. But now Alex is paying more for groceries, more for insurance, more for utilities, more for housing, more for eating out, and potentially more for borrowing money. His salary increased, but his purchasing power didn't increase by the same amount. That's the hidden problem with inflation. Inflation doesn't need to stay extremely high to hurt you. Even after inflation slows down, prices don't automatically go back to where they were. That's a critical distinction. Think of it this way. If a $100 grocery trip becomes $110 and inflation later falls dramatically, that doesn't necessarily mean the groceries return to $100. The rate of price increases can slow, while the higher price level remains. And that's why people can feel like inflation is supposedly under control. So why does everything still feel expensive? Because the damage was cumulative. And this is where the labor market becomes important. If wages rise faster than prices, households can regain purchasing power. But if wages struggle to keep up with the cost of living, people start cutting back. First, they cancel subscriptions. Then they eat out less. Then they postpone vacations. Then they delay buying a car. Then they decide not to buy a house. Eventually, millions of individual decisions become an economic force. That's the silent squeeze. Part 2. The housing market correction. Now let's talk about the biggest expense for most households. Housing. Here's something important about the 2026 housing market. There isn't one single American housing market. There are hundreds of local markets, and they can behave completely differently. In one city, home prices can be falling. In another, prices can still be rising. And somewhere else, prices might barely move at all. Why? Because housing depends heavily on local supply and demand. Jobs, population growth, new construction, mortgage rates, inventory, and affordability. Imagine 2 cities. City A has strong population growth, limited housing supply, and lots of high-paying jobs. City B has weak population growth, rising inventory, and fewer buyers who can afford today's mortgage payments. Even if both cities are in the United States, their housing markets can move in opposite directions. This is why headlines like "Home prices are crashing" can be misleading. A national housing correction doesn't mean every homeowner suddenly loses 20% of their home's value. The more realistic story is often regional. Some markets may experience price declines. Others may simply see prices flatten. And some areas can continue rising because demand remains strong. But there's another problem. Even when home prices fall, housing doesn't automatically become affordable. Let's say a house falls from $400,000 to $380,000. That sounds like good news. But if mortgage rates remain high, the monthly payment can still be enormous compared with what buyers could afford several years ago. So buyers are stuck between 2 forces. They want prices to fall, but they also want borrowing costs to fall. And sellers? Many homeowners have older mortgages with much lower rates. They have little incentive to sell and take on a much more expensive mortgage. That can keep inventory tight. And that creates one of the strangest housing markets in modern America. Prices can soften without housing becoming truly cheap. Part 3. The Gen Z Wealth Gap. Now we reach the generation facing a completely different financial reality. Gen Z. For decades, Americans were given a fairly predictable financial roadmap. Graduate, get a job, buy a house, build equity, start a family, retire. But that roadmap is becoming harder to follow. And the biggest obstacle isn't necessarily that young workers don't want those things. It's that the math has changed. Consider homeownership. If your income rises 4%, but the cost of housing, insurance, taxes, and other necessities rises faster, your financial position can actually get worse despite earning more money. And there's another issue. Homeownership isn't just about the purchase price. You need a down payment, closing costs, property taxes, insurance, maintenance, and, of course, the mortgage payment. For younger workers entering adulthood with student loans, high rents, expensive cars, and limited savings, saving enough for a down payment can feel like running on a treadmill. You're moving forward, but the finish line keeps moving. This creates a growing wealth divide. Because homeowners aren't just paying for a place to live. They're potentially accumulating an asset. Renters are paying for housing too. But unless they invest the difference elsewhere, they don't receive the same direct benefit from rising home equity. And this creates a strange generational feedback loop. Older homeowners may have purchased properties when prices were dramatically lower relative to incomes. Younger workers enter the market when affordability is much tighter. That doesn't mean Gen Z will never build wealth. It means the path may look different. Instead of relying entirely on a house, younger workers may need to build wealth through retirement accounts, index funds, business ownership, career skills, and other investments. The traditional American dream isn't necessarily disappearing, but it may be changing shape. Part 4. The De-dollarization myth. Now let's talk about one of the biggest financial headlines of the decade. De-dollarization. You've probably heard the argument. Countries are reducing their dependence on the US dollar. BRICS countries are discussing alternatives. China is promoting the yuan. Central banks are buying gold. And international trade is becoming more diversified. All of that deserves attention. But here's where social media often goes too far. You'll sometimes see headlines suggesting, the dollar is finished. That's a much bigger claim. And it isn't supported simply because other countries are trying to reduce dollar dependence. The US dollar still plays an enormous role in global finance. It's heavily used in international trade. It's central to global financial markets. And a large share of foreign exchange transactions involves the dollar. So the more realistic story isn't, the dollar disappears tomorrow. It's, the global monetary system is becoming more diversified. That's a very different statement. Think about it like this. If one currency dominates global finance, countries may decide they don't want all of their financial exposure concentrated in that currency. So they diversify. They buy gold. They use other currencies for certain transactions. They develop alternative payment systems. But diversification doesn't automatically mean replacement. And for everyday American investors, that's the important distinction. A gradual decline in dollar dominance could matter over decades. But it doesn't mean your dollars suddenly become worthless next year. The dollar's global role is a structural issue, not a viral headline. The bigger picture. Now put all four stories together. Inflation changed the price level. The labor market determines whether incomes can catch up. Housing determines how much of your paycheck disappears every month. And global monetary shifts influence the long-term financial environment. These aren't four separate stories. They're connected. When housing becomes expensive, young people save less. When inflation raises everyday expenses, saving becomes harder. When job growth slows, workers become more cautious. When borrowing costs remain high, businesses and households delay major purchases. And when people feel financially insecure, they change their behavior. That's why an economy doesn't need to collapse for people to feel poorer. Sometimes the pressure builds slowly. One grocery bill, one insurance renewal, one rent increase, one mortgage payment, one delayed promotion, 1 year without meaningful savings. And suddenly you look at your finances and realize you're earning more money, but getting less financial freedom. So what's the lesson? Don't obsess over whether the next headline says, boom, or crash. Watch the things that actually affect your household, your income, your spending, your debt, your housing costs, your savings rate, and your exposure to long-term investments. Because the biggest economic changes aren't always dramatic. Sometimes they happen quietly. And by the time everyone notices, the financial landscape has already changed. The question isn't whether the economy looks good on television. The question is, does your financial life actually feel stronger? Because in 2026, that may be the number that matters most.